Ladies and gentlemen, welcome to this lecture on comparisons across investment strategies. My name is Marco Menichetti, a professor in banking and financial management at University of Liechtenstein. I'm very happy to have the honor to guide you through this chapter. Very interesting chapter. So let us have a look at the table of contents. You see the overview on sustainable investment strategies and market volume. Then we switch to regional characteristics, which is very short, and then a long chapter on investment opportunities. In this chapter, investment opportunities, we go through questions. You see it: what, where, how, and why. And then we have a literature review, and at the end, a look on the reference list. Here I showed you another time that spectrum of capital. This spectrum of capital, you have seen that probably already several times, and I don't want to discuss that anymore, but it's interesting because it shows you from the left side the traditional finance across the different types of sustainable finance to the right, where you arrive then at philanthropy. I go to the next slide. The categories by GSIA on sustainable investment strategies, and I don't want to explain that anymore. You have heard that several times. I just mentioned them: negative and exclusionary screening, positive best-in-class screening, norms-based screening, ESG integration, sustainability-themed investing, impact community investing, and corporate engagement and shareholder action. So I go to the next slide, which shows you just the front page of a brochure, which is quite interesting: the Global Sustainable Investment Review from 2020. And all the following slides are taken from that brochure. Now, the first is a figure which gives a snapshot on global sustainable investing assets in 2016 to 18 to 20. And here you see the development of the I'm very sorry, the development of the assets under management. You have seen that already in other chapters. This is just a very short repetition. I don't want to discuss it in detail. But the next slide is then perhaps more interesting. This is gives us the proportions of sustainable investing assets relative to total managed assets between 2014 and 20, where we see the developments. And on the next slide, there are two figures. One is sustainable investing assets by strategy and region in 2020. Here, the largest sustainable investment strategy globally is ESG integration. The next most commonly deployed sustainable investment strategies include negative exclusionary screening, followed by corporate engagement, shareholder action. Well, figure 2 is proportion of global sustainable investing assets by region, and here you see the United States and Europe continued to represent more than 80% of global sustainable investing assets during 2018 to 2020. Next slide is on global growth of sustainable investing strategies, now differentiated for the investment strategies. Sustainability themed investing, ESG integration, and corporate engagement have all experienced consistent growth during the period. We come to regional shares by asset weight in global use of sustainable investing strategies 2020, and here the regional differences in the sustainable investing strategies are presented in in the figure above. For example, Europe made up historically the majority of assets, and with norm-based and negative exclusionary screening strategies. On the next slide, we have global shares of institutional and retail sustainable investing assets between 2016 and 2020. Although institutional investors tend to dominate the financial market, interest by retail investors in sustainable investing has been steadily growing. And now we come to regional characteristics. And first we come to Europe. The proportion of socially responsible investment assets relative to total managed assets declined from 59% in 2014 to 42% in 2020. That is due to the fact that assets under management professionally managed in Europe increased more than professionally managed socially responsible investments. And this is also driven by the fact that a strong relative push now explicitly sets out sustainable standards for sustainable, socially responsible investments. In 2020, relatively strong in norms-based screening, negative exclusionary screening, corporate engagement and shareholder action, and relatively weak in impact, community investing, and sustainability themed and ESG integration. Since 2020, the second biggest socially responsible investment market with 34% worldwide. On the next slide, we talk about the US, since 2020 now, the biggest regional market with 48% of the socially responsible investments. The strongest strategies are ESG integration, so that's a difference to Europe, and negative exclusionary screening. Weak are the US in norms-based screening, in corporate engagement and shareholder action. And we have Japan. After high growth, is Japan now the third largest regional market in the world? The reasons are several new legislation projects by the Abe administration, and two major institutional asset owners became signatories to PRI, the Government Pension Investment Fund, and the Pension Fund Association. So let us go to the next section. The section is investment opportunities, and as I already mentioned, here we go through this section with the questions which we ask. What type of projects to finance? Where, that means we talk about supply side and demand side. How, that means which financial instruments in use do we invest in? And the last is why, so the reasons for differences in the assets under management. Let us go to the next slide, which here we talk about the products and we talk about investments in companies. So existing traditional exchange-traded stocks and bonds are open for investments issued by companies with advances in their sustainable behavior, are positively compared to years before, and or to competitors. So here it is about ESG, about greenhouse gas emissions footprint, and so on. Companies working in fields that actively drive and accelerate the transformation to a sustainable economy with new processes, technologies, or products. They are difficult to identify, as often not exchange traded, thus financed by private equity and debt. the availability of this type of capital is reduced. And the last point, an opportunity, are also investments in real estate, in farms, in agricultural producers with sustainable approaches, projects, startups, or growing businesses offering a socially responsible or sustainable approach. Then we have also investments in sustainable commodities. Commodities that are sustainable if no damage to the environment is caused, if there is the potential to be infinite, and if production ethics are preserved. This is possible for, and this is just a selection, coffee, cocoa, coconut, palm oil, rubber, spices, timber. The availability is reduced. Exchange trading for those commodities is still missing. So it's OTC, over-the-counter trading. Next is investments in indirect vehicles. So here we have investment funds, mutual funds, exchange traded funds, ETFs. Content in which is invested are private or public equities and bonds, then commodities, or it's also possible mixed funds. It's possible open-end or closed-end. Open-end would mean variable capital and shares of the fund. Closed-end, restricted capital with IPO. And then exchange trading, yes or no. And for ETFs, sustainable indices are needed. And we have financial legislation, which is local, which is European-wide, the UCITS or the AIFM. On the next slide, we discuss the differences in preferences and goals between the financial sector, the sellers, and investors, the demand side, based on the literature. So before I wrote down what you see here, I had, of course, an intensive literature review. Who is the supply side? The supply side are banks, asset and portfolio managers, advisors, brokers, in general, sellers of financial products, also insurance companies. There are project developers and institutions from outside the financial sector. Think about shadow banking. Demand side, institutional investors are there with different level of client power and family offices. And of course, there are also retail investors with different categories. So you see here, we are now on the supply side, and we check the goals of the supply side. The goals are numbered S for supply side, 1 to 8. So you see here we have maximize non-interest fee income. Yeah? Or low total amount of salaries to produce and sell the financial product. Then growth perspectives, low cost, regulatory compliance, and so on. And if we go to the demand side, then the goals, you see it here with D, 1 to 11, avoiding investments in irresponsible business practices, superior financial performance, low overall costs of the investment, low risk, asset value growth, liquidity of the investment, investing for fixed planning horizon, avoiding a minimum investment required. Investment results should meet lifestyle expenses, tax efficiency and tax advantages, and practical possibility in measurement and comparability of the social and environmental impact. So these are the goals of the demand side. Now, supply side offers two different groups in sustainable investment strategies with a priority for group 1, if you see. So what I did here is, for the supply side, I went through the goals of the supply side, and for group 1 and group 2, which means group 1 is the investment strategy exclusions, engagement and voting, ESG integration, norms-based screening and best in class. And group 2 is sustainability themed investing and impact investing. So we have these two groups, and for these two groups I gave a valuation of the decision criteria. Plus means very positive, and minus means very negative, and there were some stages between. So you see there were, for group 1, there were more pluses than for group 2. And I did the same for the demand side. And here we have the decision criteria another time, and I gave valuations for the decision criteria, how much it's fulfilled. Here for group 1 and group 2 investment strategies. And you see another time group 1 has 18 pluses and 2 minus, and group 2 only 7 plus and 7 minus. So group 1 is another time here better. And I go to the next slide, where I now talk about the results. Supply side analysis shows a preference for group 1 sustainable investment strategies, and demand side analysis also shows a preference for group 1 sustainable investment strategies. This is perhaps surprising and unexpected, but in the evaluations on the last slides, I really assume preferences of the average investor as observed in reality. Group 2 sustainable investment strategies would be more beneficial for a transformation to a sustainable society, but Group 2 is not preferred. These results are a snapshot, of course, and preferences could change fast over time, and probably with a development of the society to a sustainable society, this will probably also change. But at the moment it's like that. The preference for Group 1 sustainable investment strategies from supply and demand side explains now the niche situation of the Group 2 sustainable investment strategies. Yeah. So now, if you we think what we have developed over the last slides, it's clear that impact investing is so weak. Yeah. And ESG or best in class and so on are extremely strong, because they are preferred from both sides, from demand side and from the sell side at the moment. Good. We go to the question how. How can we invest? And that's easy. So we invest in stocks, equity, in bonds or loans, money market instruments, deposits, commodities, collective investments, mutual funds, structured products, yeah, and more, of course. On the next slide, the impact investing asset allocation between 2013 to 2012 gives us an overview on the most used investments. And here we see the highest assets under management are held by private debt, followed by private equity, and then by public debt. So we go to the next slide. We go to why, the reasons for the differences in assets under management. We already mentioned the two different groups of investment strategies, Group 1 versus Group 2. Supply side analysis shows a preference for Group 1 sustainable investment strategies, as this shows advantages to the offering institutions, measured according to their goals. And demand side analysis also shows a preference for Group 1 but also a little bit for Group 2 sustainable investment strategies. Group 2 sustainable investment strategies would be more beneficial for transformation to a sustainable society, but at the moment the demand is more for Group 1. Well, the current strong preference for the supply side of Group 1 sustainable investment strategies explains that niche situation of Group 2 sustainable investment strategies. Okay, we come to the table of contents, and our next section is the literature review. And here we have two papers which I analyzed very short, or reviewed very short. There is the paper Busch, Bauer, Orlitzky from 2015 in the Business and Society. The title is Sustainable Development and Financial Markets, Old Paths and New Avenues. And the second paper is from Zan and Santos Paulino from 2021. The title is Investing in Sustainable Development Goals, Mobilization, Channeling and Impact. And this is published in the Journal of International Business Policy. Okay, so let us start with the first paper by Busch, Bauer, Orlitzky. Here the research question is: the authors explore the roles of financial markets for sustainable development. They ask to what extent financial markets foster and facilitate more sustainable business practices. The methodology. Authors highlight that their current role is rather modest and conclude that on the old paths a paradoxical situation exists. On one hand, financial market participants increasingly integrate environmental, social and governance criteria, ESG, into their investment decisions, whereas on the other hand, in terms of organizational reality, there seems to be no real shift towards more sustainable business practices. And the findings, the authors identify two main challenges within the field of sustainable investments that are relevant for entering new avenues that may help to overcome this situation. First, a reorientation towards a long-term paradigm for sustainable investments is important. And second, ESG data must become more trustworthy. From a theoretical point of view, the authors finally highlight the potential market consequences when ESG investment criteria are used. This paper is highly recommended to be read when working on sustainable finance and investing. That gives you a very good insight into the background of the whole field. I come to the next paper by Zan and Santos Paulino. The research question: global investments in the Sustainable Development Goals is falling short of the target to close the 2.5 trillion annual financing gap for developing countries. The COVID-19 shock has exacerbated existing constraints for the SDGs and may undo the progress made in the last 6 years in SDG investments. This poses a risk to delivering on the 2030 Agenda for Sustainable Development. The methodology. The authors analyze the main challenges for mobilizing funds, channeling investment into SDG sectors and maximizing positive impact, as well as major regulatory dilemmas in promoting SDG investment. The article then elaborates on a set of policy measures for accelerating investment in SDGs, including principle for guiding private sector investment, mainstreaming the SDGs into national and international investment policies, and promotion strategies, harnessing financial instruments for sustainable development, building special SDGs model zones, and promoting better ESG standards, compliance and reporting. So we come to the findings. The authors contributed a critical analysis concerning reaching the SDG goals. They assessed the array of financial instruments launched to respond to the COVID-19 health crisis with economic and social impacts. The pandemic is exacerbating SDG financing gaps in developing countries. The paper underlines practical ways and means to operate with UNCTAD's investment policy framework for sustainable development from 2015. The authors also underline that there are also other issues beyond investment which may affect the path achieving SDGs, which need broad-based policy interventions in low and middle income economies, like lack of capital, technology, production skills, and many more. This paper is also recommended for reading. It's really interesting. It covers many different areas of sustainable development and finance and relates them to each other. So we come to our table of contents, and the reference list is our last issue here. Have a look at the papers mentioned. I think there were really interesting papers, not only those two which we have discussed here, but also the others are, most of them are really interesting. And I recommend you to have a look at them. Okay, ladies and gentlemen, I finish here this chapter, Comparisons Across Investment Strategies. I hope that gave you a good overview now on the links between the different investment strategies. Probably you now have a better understanding why some strategies are very successful, other strategies have an extremely low assets under management. And yeah, so I think could be you have now a better understanding of the whole story. I thank you for your patience and wish you a nice time and advance in studying sustainable finance. Good luck and take care. Bye bye.